Well, good day, traders, and happy Friday to all. And I want to just caveat by saying that I am recording this video prior to receiving the China data dump. So, of course, we're talking about the Q3 GDP numbers. The market's looking for 6.1% industrial production, fixed asset investment and retail sales. And we were saying this before. We've seen Vice Chair of the Fed, Richard Clarida, the architect, or the market's perception of the architect behind Fed policy, one of the most important members of the Federal Reserve, giving us the last bastion of Fed speakers before we see the Fed meeting at the end of the month. Now, we go into that blackout period, the markets, so if you look at Fed funds futures, implying an 82% chance of a rate cut. We'll go into the rates pricing in a moment just to give you a sense of how that's positioned as we go into the new week. But certainly at the moment, Richard Clarida having a chance to have a look at that market pricing and saying, well, if we're going to see a cut, there's a good chance on the cut. You know, we're going to see that rhetoric, very much giving us that in line with what we've been seeing. Obviously, if he believes that the board don't want to see a cut, he wants to subdue volatility and keep that low. So he'll probably change his guidance around that and talk that rate pricing down. So that's obviously quite important. But have a look at the platform as we go into the new week. See how G10 or major currencies have fared this week as we go forward. You can see it's been the pound once again, the superstar currency of G10 and major effects there, up 1.8% against the US dollar. So cable's had that nice move up. That platform that we've seen from 122 into the high 129s is in a bit of a reversal there. Obviously, people are a bit concerned that the DUP party are not going to vote this through. We'll talk about that in a moment. But certainly sterling has been the superstar there. There has been a big position adjustment. We've seen that from the commitment of traders reports. We can talk about the positioning in a moment. But certainly sterling yen doing very nicely on the week. Sterling Noki doing incredibly well. The Noki's been one of the weaker currencies, if not the weakest currency in G10. Sterling Real, if you want to go a little bit more exotic, you can see that that's had a decent move up there. The Brazilian Real down 1.3% against the greenback there. The greenback itself, I think, is really interesting. Have a look at euro against the dollar, up 75 basis points on the week. You can see it's broken through the June downtrend. You can see it's taken out this kind of horizontal supply zone around 110.75. It looks reasonably compelling. That daily chart suggesting to me that there's still a bit more juice in the upside there, but you probably want to be looking to buy pullbacks in that. We've seen a decent sell-off coming through in German bunds. In fact, there's been a sell-off in the bond market more broadly, both nominals and reals. And I think that idea now that there is a wider discussion from the CDU party, Merkel CDU party, about potential fiscal stimulus should the economy get a little bit worse. You've got that fiscal put going through in the German economy, which I think is supporting the euro to an extent. But you can see the daily chart warming up a little bit, and that's really pushing the dollar index a little bit low. We see that down 3 days in a row. It's down 0.5% for the week. But certainly, there's been cries, certainly from the sell-side strategists, that we have seen the peak now in the US dollar. Going into those structures, going back to that Noki, we talked about how weak that was at the moment. Euro Noki, all-time highs. Do we buy all-time highs? Well, I certainly like the idea of buying pullbacks. There's a reason why it's all-time highs. People love fading moves around all-time highs, but that's one to put on the radar. Have a look at Noki SEK. You've seen it break out to the downside of this range we've been in since August. Again, I think for me, looking to sell Noki SEK into any kind of rallies looks like a good trade there as well. But certainly Euro Dollar making a climb higher on the week against the greenback, and actually it's looking pretty good against things like the Noki and other currencies there as well. But I think when you're looking at the pound, have a look at this chart here of my implied volatility for the week. This is 1 week at the money implied volatility. Have a look at the column that you can see, 1 week ATM IV implied volatility. The divergence that you're seeing in G10 currencies at the moment, I've got a couple of cheeky ones in there. You've got dollar CNH and also dollar Turkey. A few requests from clients to put those ones in because we've seen a bit of business in there. People looking to trade the Turkey because of what's been seen in the curry structures. But certainly, if you have a look at that divergence there and have a look at IV rank, we've used the 12-month rank there. So we're looking at the implied volatility structure in that 12. Where does that sit in that 12-month rank? You're looking for context across that situation. Cable, 20%, 1 week implied volatility, 20%. That's obviously getting into the sort of 100 percentile. Euro sterling, we're up to 98 percentile. Sterling Aussie, I could have used sterling yen, that would be up there as well. But it's really the sterling crosses where that implied volatility is very, very high. This Brexit scenario that's playing through, idiosyncratic. It's very ring-fenced within that UK asset. People have said to me, Chris, well, if we are going to see a really worst-case scenario playing through, of course, people are pricing out and have priced out that no-deal risk. Why are we not seeing higher volatility in Europe? If we are going to see a bad situation playing through, surely European economy is going to struggle as well. Certainly the French economy would. But have a look at euro-dollar of implied volatility, 6.83. That sits mid-range of the 12-month rank. Go out to some of the other currencies, dollar yen, Aussie dollar, dollar CNH, dollar CAD, we're getting in down to that sort of 20 percentile. So outside the sterling, actually volatility in G10FX is very, very low at the moment. People are not expecting big moves up or down from where we are at the moment. That distribution is expected to stay fairly contained within markets. If you like that volatility, if you find that a good happy hunting ground, sterling's the place to go. Have a look at cable. If we actually extrapolate that into the straddle pricing, you can see here that the expected move from spot with a 68.2% level of confidence, those price distributions are expected to stay within that one standard deviation of 320 points. Now, that gives you a high, an implied high based on straddle pricing. If you want to go and buy volatility in the options market, you're expecting to break even around 131.92 down to 125.52. Now, that if we want to take that out and have a look at 10 deltas, give us a bigger idea about the extreme moves, the 90% level of confidence playing through. You can see here on the Bloomberg chart, I've drawn this kind of playbook on what we're expecting there. So we're at 134 down to 124. So it's about 1,000 point, or just an 800 point move or so in that. And I think that's quite interesting because, as you can see here, the market's expecting some big moves. Now, as we go through to the playbook, as I say, I'm saying this before we get the parliamentary vote playing through. Are we going to see the extension to Article 50? Obviously, under the Ben Act, one suspects that they're going to have to make that request. Will it be accepted? Juncker's comments throw an element of doubt into that, but one suspects Donald Tusk will have his say, and the EU 27 will grant them an extension. What does that look like? Probably to the end of January. And I think ultimately, will we see that vote being passed through Parliament over the weekend? Now, the math that we're seeing at the moment suggests we're probably going to see something like 310 to 315 votes at best. So there could be some modest downside risks to sterling crosses as we go into the Monday Open. But the fact that I'm thinking about that suggests that most people believe that there's a small chance that we're going to see, or a good chance we're going to see this voted down. So we should see the downside relatively contained if they do so, and then they request the extension. Obviously, if this does pass, if we get enough Labour voters to go through and we get independents coming in there as well, one suspects you're going to see a pretty punchy open on the Monday morning, that gapping risk. So obviously, we're seeing a bit of position adjustment as we go through Asia today. I think some of those shorts are taking profits or taking some off the table there just to be assured that we don't have that gapping risk. It is an event risk that we all have to manage. Do have a look at risk reversals. Have a look at this chart here. You can see in risk reversals in cable especially. I think that's really interesting now. Negative 0.6. That was up at 1.5 positive. So people have been bigger buyers of call upside. Those 25 delta calls have now subsided. People are bigger buyers of downside structures in sterling on 1 week options there. So put volatility is increasing relative to call volatility, and actually the premium now that you can use to buy 1 week implied volatility in cable is more expensive for puts than it is in calls. People are therefore seeing downside risks in the cable, and that's really interesting because a week ago or so you had people looking for much higher upside. So in terms of the spot, it's still gravitating just shy of 129. The options market though is telling you that people are betting or speculating that we're seeing downside risk. They're hedging that exposure there as well, and I think that's really interesting. People are looking for that downside risk. I think that seems fair, given that I believe that on the current trajectory, on the current maths that we're seeing, is that we're going to see this just shy of going through. What does that look like? Of course, that's going to be something we're going to be exploring next week. If it does fail, what will be the chances of an election? When will that date likely be? Could we see a possibility of a second referendum? There's going to be a lot of questions that the market's going to be answering, but one suspects a general election will have to be called at some stage. If we go through the data-wise, we've got in the US, there's not a lot to really focus on. A lot of two-tiered, second-tier data. Probably durable goods, I think, is going to be the big one. We've seen some weakness playing through in some of the data points of late. We're probably running in the third quarter around about sort of 1.3, 1.4%. In Australia, well, I think the interesting situation there, if you have a look at the chart that I've got of interest rates, you can see here in that third column there that the Fed policy, 82% chance that we're going to get a rate cut at the 30th of October. In Australia, though, go down to the RBA column there on the 5th of November, Melbourne Cup Day. Now, that the implied probability of a rate cut from the RBA has fallen to 15%. You go out the swaps curves, you've got 23 basis points being priced in over 12 months. So there's not even one full rate cut being priced in now. We did see Terry McCrann, a lot of the international guys really put a lot of weight on Terry McCrann as an RBA whisperer. He's said that that there's not going to be a rate cut in November. The comments we've heard this morning from Philip Lowe, the RBA governor, suggesting that we're getting diminishing to returns from rate cuts, and that all they're doing is boosting existing asset prices and not going to produce new loans and new credit demand. Probably very fair, but you know, the idea now that we're going to get a November cut has been reduced quite significantly. The idea then that we get a December cut has probably been reinforced somewhat, but the market's seeing that as 50-50. So I think the Aussie dollar looks quite interesting in that capacity as well. Bank of Japan, well, we've got a 36% chance that they cut rates. I think people are looking at other aspects there. Bank of Canada, 2%. The RBNZ still very much the next bank to move, expected fully pretty much on the 13th of November there. But rate cuts have come out of the markets now, and I think that's really very interesting as well. Australia, no real data, which I think is going to be worth looking at next week in terms of major driver for price. China, again, not a huge amount to really focus on there for the week. In Europe, we do have the ECB meeting, but going back to that volatility structure, you can see that implied volatility in that is we're seeing around 56 percentile. So that really covers the ECB meeting. Markets are not expecting that to be a particularly volatile event, but we are seeing more constructive flow in the euro, and I think maybe that's some position adjustment, but also the idea that probably monetary policy has done its dash in terms of the deposit rate, and the idea now that we're creeping up. There has been some calls for fiscal policy, which of course would be a euro positive there as well. So we're watching for the new week. Well, again, it's very much around what's happening Brexit. We saw those implied vols very high. The market's expecting forward. If that's not a good ground for you to stay out of the pound, if you like that volatility, that's where you're going to be. But there's a lot of questions we're going to be asking next week. If the vote fails, if it passes, then you're obviously going to see a nice upside move there. We've talked about the different dynamics playing through, but it's going to be a pretty quiet week aside from that. And, you know, it's all Brexit watchers at the moment there.